Introducing Perwaja Steel, a lesser-known company that once held the distinction of being one of Malaysia's largest steel producers. With a reported capacity of over 1.5 million metric tons of steel per year, it made significant contributions to the economy. As an enterprise initiated by the Heavy Industry Corporation and renowned Japanese company Nippon Steel Corporation, Perwaja Steel had access to invaluable expertise and substantial capital. These advantages should have propelled the company to greater success. However, as we delve into the story, it becomes clear that Perwaja Steel's fate took a different turn. To gain a comprehensive understanding, let's start from the very beginning. Perwaja Steel was established in 1982 as part of Malaysia's drive to promote industrialization and reduce the country's dependence on imported steel. With the backing of the Malaysian government and a joint venture with Japan's Nippon Steel Corporation, Perwaja Steel aimed to become a key player in Malaysia's rapidly growing economy. The company's initial success appeared promising, with the construction of an integrated steel mill in Kemaman, Terengganu, and the production of billets, bars, and wire rods. In the initial years, Perwaja Steel aggressively pursued its vision of being the cornerstone of Malaysia's industrial sector. The state-of-the-art steel mill in Kemaman was equipped with advanced technology, introducing an electric arc furnace and continuous casting facilities, giving the company the ability to produce a wide variety of high-quality steel products. Despite having modern facilities and a clear vision, the company started facing challenges early on. One of the main obstacles was the lack of a local skilled workforce experienced in steel manufacturing. This problem was exacerbated by the fact that Malaysia was relatively new to large-scale steel production. Thus, in the early years, Perwaja Steel was heavily reliant on Japanese experts from Nippon Steel Corporation, leading to high operational costs. While it had a promising start, Perwaja Steel began to exhibit signs of trouble by the late 1980s. These early red flags were mostly unnoticed, swept under the rug in the face of optimism, but their consequences would be impossible to ignore later on. One of the primary issues that the company grappled with was cost overruns. The costs associated with the company's operations were spiraling out of control, far beyond what had been budgeted for and anticipated. This resulted in substantial financial strain, with expenditures persistently outweighing revenue. The cost overruns were not occasionally hiccups, they became a constant burden, eating into the company's finances relentlessly. Perwaja Steel also found itself grappling with the obsolescence of its technology. In an industry where technological innovation was quickly changing the way things were done, the company was stuck with outdated techniques and machinery. It was not keeping pace with the rapid technological advancements that were transforming the steel industry globally. This technological backwardness resulted in decreased efficiency and an inability to meet production targets, undermining the company's competitiveness. Moreover, the global steel industry during this period was in the throes of a major downturn. The world market was characterized by excess capacity and declining prices, a disastrous combination for any player in the industry. These circumstances meant that Perwaja Steel was swimming against a very strong tide, trying to compete in an international market that was increasingly unfavorable. Compounding these issues was the rampant financial mismanagement and corruption within the company. A culture of irresponsible handling of funds, combined with widespread corruption, served to exacerbate the already dire situation. A series of audits brought to light the shocking extent of this mismanagement. It was revealed that Perwaja Steel had accumulated massive debts, partly as a result of these poor financial controls. Funds were being siphoned off by company officials, leading to an even more precarious financial situation. By the early 1990s, Perwaja Steel's financial situation had deteriorated alarmingly. Losses were mounting, with the company bleeding money at an unsustainable rate. The accumulated debt had ballooned to an astonishing figure of over 9 billion Malaysian ringgit, equivalent to approximately $2.8 billion at that time. This was a colossal sum, particularly for a company that was struggling with decreased revenue and overruns on the cost front. The promise of Perwaja Steel was fast turning into a nightmare. With a combination of internal challenges and external market pressures, the company was set on a course of financial disaster, a far cry from the potential it had shown during its inception. The story of Perwaja Steel serves as a cautionary tale about the pitfalls of financial mismanagement, the importance of technological innovation, and the perils of competing in a difficult market environment. By the mid-90s, Perwaja Steel, one of Malaysia's significant industrial entities, found itself on the brink of failure. The alarm bell started ringing across the Malaysian economic landscape, forcing the national government to step in to save the ailing corporation. The gloomy prospect of Perwaja Steel's collapse carried the potential to send shockwaves throughout the Malaysian economy, necessitating swift and decisive action from the government. In 1996, as a testament to the government's commitment to keeping this vital cog of the country's industrial machine running, a comprehensive rescue plan was laid out. At the core of this plan was a massive financial intervention. A fund of 2.9 billion ringgit, equivalent to approximately $900 million at the exchange rates of that time, was allocated to be injected into the beleaguered company's coffers. But the government's efforts weren't just a quick fiscal band-aid. Along with the influx of funds, a strategic restructuring of the company's management was also part of the rescue plan. A completely fresh team of executives was appointed, with the responsibility of steering Perwaja Steel out of its troubled waters and onto a more prosperous course. The plan also included the divestment of non-core assets, a move aimed at streamlining operations and refocusing the company's energy on its core business. In addition, the government recognized that foreign investment and external technical expertise would be vital in reviving Perwaja Steel. The inflow of foreign capital would provide the much-needed boost to the company's finances, while the technical know-how could help address some of the operational inefficiencies plaguing the firm. To this end, efforts were directed towards making the company attractive to foreign investors and technocrats. Despite the government's well-thought-out plans and massive efforts, the road to recovery for Perwaja Steel was far from smooth. The company's struggles, unfortunately, did not abate, and it continued to bleed financially. Losses continued to mount, painting a grim picture of the company's health. In addition, production levels remained disappointingly low, further impeding the firm's path to financial recovery. Throughout the closing years of the 90s and the dawn of the new millennium, a series of additional restructuring plans were set into motion. There were more management shakeups, with new faces and fresh ideas brought in to try and steer the company towards profitability. However, these continuous changes and initiatives, much like the earlier rescue plan, failed to reverse Perwaja Steel's misfortunes. Despite the repeated attempts at reviving the company, it seemed that the steel giant was stuck in a quagmire of financial difficulty and operational inefficiency. Perwaja Steel's long-standing struggle for survival was further exacerbated by an unexpected global event. The late 2000s saw the world gripped by one of the most severe financial crises in history. The global financial crisis of 2008 to 2009 wreaked havoc on economies around the world, and its repercussions were felt acutely by Perwaja Steel. Steel is a fundamental commodity in the world's industrial cycle, and the crisis led to a significant downturn in demand for it. Global industries were severely impacted, with many manufacturing plants slowing or halting their operations. The contraction in worldwide economic activity resulted in a precipitous drop in the demand for steel. Simultaneously, steel prices, closely linked to the cyclicality of the global economy, faced a cataclysmic collapse. As a steel manufacturer heavily reliant on both domestic and international demand, Perwaja Steel was hit hard by these developments. The company's revenues, already teetering on the edge due to years of financial distress, further declined. As revenues dwindled, servicing its massive debt burden became an impossible task. The reduced income simply couldn't cover the interest and principal payments, leading the company to default on its obligations. In 2009, as a consequence of its mounting liabilities and dwindling resources, Perwaja Steel was officially declared insolvent. With the realization that the company was incapable of paying off its debts, control was passed on to Malaysia's National Asset Management Agency, Pengurusan Dana Harta Nasional Berhad. The agency took on the unenviable task of administering and trying to recover as much value as possible from the ailing steelmaker. Despite the grim circumstances, the government didn't entirely abandon Perwaja Steel. In 2011, another rescue attempt was made in a bid to salvage the company and its contributions to the Malaysian economy. A new bailout plan worth 1.8 billion ringgit, equivalent to approximately $590 million at that time, was approved by the government. This rescue attempt involved not just a financial injection, but also a significant strategic move. The plan included the sale of the company's assets to Malaysia's Kinsteel Group, a major player in the steel industry. The expectation was that Kinsteel, with its vast experience and resources, would manage to turn around Perwaja's fortunes and restore its profitability. However, even this massive injection of funds and the strategic ownership shift did not manage to pull Perwaja Steel out of its quagmire. The company remained mired in financial troubles, with losses continuing to pile up. Operational inefficiencies, a long-standing problem that had haunted Perwaja Steel for years, continue to persist. This, combined with the challenging financial situation, ensured that the company's path to recovery remained blocked, reinforcing the belief that the giant's glory days were, indeed, a thing of the past. In conclusion, the fall of Perwaja Steel Malaysia offers a compelling case study in the challenges and pitfalls that can arise in the pursuit of industrial development. The company's rise and fall serve as a reminder of the importance of sound financial management, corporate governance, adaptability, and the need for limited political interference in business operations. But anyway, do let us know what you think. Thanks for watching.